Hey everyone, welcome back to the channel. Today we're talking about long and short positions in investing. How people make money, whether markets are going up or down. This comes from an article that breaks it down clearly, so let's go through it step by step. Okay, first the basics. Investing isn't just about buying something and hoping the price goes up, of course. Sure, that's common. You buy an asset, wait for the value to rise and sell for a profit. But markets let you do the opposite too. Profit when prices drop. These are called long and short positions. They help decide where money goes, how risks are shared, and how prices react to news. Knowing them explains why some investors win during tough times, why markets can crash, and why not everyone loses the same. So what's a long position? It's when you buy an asset expecting the price to go up. If it does, you sell and keep the difference as profit. If it falls, you lose money. This is how most people invest worldwide. Think buying company shares, putting money in a fund that tracks the market, or getting real estate. It's tied to growth. When companies do better, make more products, and earn more, their value usually increases. That's why long positions are big in retirement plans, pensions, and family savings. They're about riding long-term trends, not quick ups and downs. Now, the upsides and downsides of long positions. The big plus is the potential. Gains can be unlimited, but losses are limited to what you put in. If you buy a stock for a certain amount, you can lose more than that. Time helps too. Even after dips, you can recover if you hold on. That's why it's good for goals years away, but it's not without risks. You're open to market drops, rising prices that eat into value, or long stretches of no growth. If the economy slows or prices get out of whack with reality, returns can be low or negative for a while. So you need patience, spread your investments, and handle ups and downs. Next, short positions. These let you make money from falling prices. You borrow an asset, sell it now at the current price, then buy it back later. If the price dropped, you pocket the difference. It flips the usual buy then sell order, which can seem odd, but it's useful. It lets people point out overpriced assets, weak businesses, or trends that won't last. It's more about checking value and risks than just being negative. Mostly pros use it, not everyday folks, because it's trickier and riskier. Shorts can make markets better by questioning hype and spotting issues, leading to fairer prices and more openness. Losses can be unlimited since prices can keep rising. A quick jump can force you to buy back at a bad time, making things more volatile. You need constant watching and good risk controls. Markets generally go up over time, so shorts fight that trend. Timing matters a lot. That's why they're not for beginners. People think shorting is like gambling, but many do it with deep research. Another is that longs are always safe. Losses are capped, but you're still hit by market cycles and big drops. Both have risks. The difference is in how complex they are, what you're exposed to, and who they're for. Longs show up in everyday stock investing. Families in broad market funds gain from steady growth, new ideas, and company profits. Dips hurt short term, but staying in over years adds up. That's why longs are core for most people. Shorts stand out in crisis when prices don't match reality. In the 2008 financial crisis, US housing issues led to big losses in related loans. Investors betting against them profited as values fell and defaults rose. Reports later showed how this shifted wins and losses in the system. Shorts have exposed company problems too. Wirecard collapsed in 2020 after cash claims couldn't be checked. Reviews by European groups noted oversight failures, but shorts and reports flagged issues early. Regulators acted late. A twist happened with GameStop in 2021. Pros shorted it heavily, seeing decline ahead. But everyday investors bought in big, not for business reasons, but to squeeze the shorts. Prices spiked, forcing buys to cover, pushing it higher. A US report said this mix of crowd buying and heavy shorts caused wild swings and losses for some. It showed how packed shorts can spark chaos when trading and structures clash. In conclusion, for most people, long investing is best. It's straightforward, caps big losses, and matches long-term growth. Shorts are more niche, helping markets run smoother and manage risks, but need skill and toughness. Understanding both gives a better picture of markets, why prices go both ways, why crises have winners and losers, and why investing is about smart choices, not just hope. And that was the video on long and short positions. What do you think? Is shorting something you'd try or stick to longs? Drop your thoughts in the comments, like if this helped, and subscribe for more finance breakdowns. And see you next time.